Howdy, Jacob here. Today we're looking at Columbus McKinnon Corporation in the machinery industry, $1 billion market cap on 1.4 billion enterprise value. Looks like they design, manufacture, and market motion solutions for moving, lifting, positioning, and securing materials worldwide. Founded in 1875. And it's got this growth. That's crazy. All right, so I guess it's because post-COVID, I'm sure a bunch of people were building, which spurred a lot of demand for this product. 39% year over year. We saw the same thing in 2018, 31% year over year. Otherwise, outside of those two periods, pretty dampened. So let's first look at 2018 and 2022 and see if there were any acquisitions. So 2022, big acquisition. 2018 must have been organic here. I'm not seeing anything that would really spur. That's 2017. Maybe it was a delayed revenue. So that could be it, but this one was definitely a $500 million acquisition. $540 million acquisition. That's crazy. It's half their market cap. Anyways, gross margin in the low to mid 30% range. Operating margin, upper single, lower double digit, with a dividend per share that they can easily afford based on their earnings per share. So we're definitely not concerned about that payout ratio. And it is 0.78%. So, I mean, really not terrible. Return on invested capital, pretty poor. So, I mean, makes sense that they're giving money back to us as shareholders through dividends because the reinvestment capabilities are not historically fantastic. 114%, $114 million on cash and equivalents, with 51 million short-term debt, 480 million long-term debt. Quite a lot of lines on this balance sheet. Okay, current portion of capital leases, deferred revenue, pension liabilities. I mean, they got a lot of stuff on this balance sheet, but biggest things I'm concerned about, 500 million in debt. Let's see what that is in relation to cash flow. I mean, quite a lot. Jeez. 50 million in the most recent year, even including these 100 millions, it's probably averaging out to about 70, 75, 80 million, which is, I mean, 80 million is about 5 times, or that 500 million is about 5 times their 5-year average free cash flow. But, I mean, I guess, all right, I'm just looking at the balance sheet, seeing if they've gone up a lot, which they have. Their long-term debt's increased quite substantially. So, I mean, free cash flow has not increased nearly as much as their long-term debt. So their payout ratio, or their free cash flow to debt ratio, is really gone up, which, I mean, this acquisition should have spurred a hefty amount of free cash flow, and we're not seeing it. I mean, if I were paying $500 million for a company, I would want them to be producing 50 mil, maybe, or they're going to spur a bunch of growth for me. I mean, either way, it was one-time big increase in revenue, but since then, really not seeing anything special here. So with a lot of their money going towards acquisitions, I'm just not seeing historically they've been fantastic at it. Just my perspective, what I'm seeing on the numbers here. From that, let's go to making our assumptions. So on the revenue growth side, I mean, they make a lot of money, or they make a lot of revenue growth through acquisitions. So let's say they grow 4% a year. I don't think they're nearly as good as the average market from return on invested capital standpoint, organic growth, and strategic acquisitions. So I'm comfortable with a 13P there. I think on the margin side here, their free cash was a lot higher. I mean, that's like the only thing that I really like about this. Maybe 5 and 7% with share change of, can they offset stock-based compensation? $11 million. I mean, it's like 15, 20, less than 20% of free cash flow going towards share repurchases, but they're not doing it. But, I mean, 10 out of that is 1%. So I guess increase shares 1% a year. The dividend payout, I never actually looked at that. $8 million. I mean, they can definitely afford that. Have they increased it? Okay. Well, they increase it every once in a while. So maybe I'll say I'll just grow it with their revenue growth assumptions. And we're saying it needs to fall 62% before you get the return I'm looking for here. So I will be waiting patiently before it gets to a price that's more attractive to me. Hope you enjoy the video and have a great rest of your day. Thank you.